Welcome to the live stream. I'm Mitch Goldberg. You're listening to Money in the Morning. We're talking about auto workers strike, Fed meeting this week, and earnings season doesn't really start until about August 7th, August 8th or so, just end of the first week of October. And right now it's only mid-September. So there really isn't a whole hell of a lot going on right now. And even though the Fed meets on Wednesday. It meets this week, Tuesday and Wednesday, but they announced their Fed interest rate. They announced their interest rate policy meeting on Wednesday. Uh, it's pretty much baked into the cake, 99% chance that they leave rates alone, unchanged. So it's really just ho-hum and not a whole hell of a lot going on, not a whole hell of a lot to give us direction. We need to see if this auto strike, and we might see strikes taking place in the healthcare field. We have the Writers Guild right now in strike. Labor is reasserting itself to get higher wages, cost of living adjustments, better healthcare, etc. And while I applaud anyone who does the best for themselves and who wants to gain a leg up in the economy and better their financial situation for themselves and their family, we have to take into consideration what this means. And one of the biggest changes to the economy in the last 40 years, certainly in my career, is the inflation rate. And if labor is asking for more money, what does that mean for artificial intelligence, robotics? Does it actually help labor or does it hurt labor? And what does it mean for the stock market? So we'll talk about these things and more. Let's roll a quick intro, and we're just going to take you right through a quick rundown on today's action. Here we go. All right, welcome to the live stream. So, a couple of big pieces of news. First of all, the in the midst of politics and primaries going to be happening in the not too distant future, and what's going on with the economy? Is the Fed going to keep raising rates, lowering rates? We are now facing a strike in the most amount of labor hours lost in probably 20 years between the Writers Guild, and now it's taking place between the auto workers. The auto workers right now are striking in just a handful of plants to basically gum up the auto manufacturing sector. So there are still auto workers working, and cars are being assembled and put together. But by taking a couple of key factories offline, like the ones that make some electric cars and that make SUVs and pickup trucks, it's enough to gum up the system. So even if they're not all striking, if the whole union isn't closing down the entire companies of Stellantis, that's a company that makes Chrysler and Wrangler and Ram and GM and Ford. So if they don't do that, it's still going to feel like it. What does this mean for the economy? I think it's pretty much agreed upon by economists, market watchers, that anything shy of a 3 or 4 week strike is very manageable for the economy. More than that, we have to start thinking about how this slows down GDP. We also have to consider that there are things that are not in control of the Federal Reserve. Now, the Federal Reserve raises rates. It slows down the economy by making the cost of money go higher. So if interest rates to buy, interest mortgage rates or auto loan rates keep going up, it makes these products more expensive and it makes it harder to buy. And you either buy less of them or you don't buy, and that hurts. And when you don't buy, people stop making carpet or sell less tools and sheetrock at Home Depot, and it just spreads throughout the economy. We have to see what this does to the economy. It might even make the job of the Federal Reserve easier. But this is not under the control of the Fed. The Fed has no control over this. The Fed also has no control over the price of oil, which West Texas Intermediate is now in the 90s, well above its trading range of up to maybe 87 per barrel. and it looks like it's been sticking around above that level for a while. It looks pretty sticky, is what I'm saying. And you know, we could conceivably we have to consider $100 per barrel and maybe 4.5 to $5 per gallon national average. There's nothing that the Federal Reserve could do about that because this is in part on supply cuts from oil producers, in particular Saudi Arabia, voluntarily cutting production, and Russia, who is cutting production because they really can't keep their oil fields operating the way they used to be because they can't get parts, they can't manage oil fields. And in Russia, once you close an oil field, it could take years to reopen it. They're not something like you could flick on and off with a light switch. So, having said that, there is so much uncertainty right now, and investors appear to be stuck like a deer in the headlights. But usually, uncertainty does translate into selling. Now, why haven't we seen selling yet? Well, the economy is still in pretty good shape. The US still has the CHIPS Act in place, the infrastructure in place. These are all big job builders. Infrastructure, these create a lot of union jobs as well. So the fact that we're seeing a labor strike, well, it does strike me as this. Some people say, well, record profits, so labor should share in that. But here's the thing. What if we have a recession and automobile manufacturer profits go down? Will the unions take a hit in that case? Will they say, oh, you're right, we better give back some of our hard fought gains for our cost of living adjustments and higher pay? That's the problem. Once you give the money, you raise the wages, they don't go backwards. So, but if the argument is we should get paid more because the profits of the company are doing better are so high, then it should be that when the profits go down, you should be willing to give up some of those hard fought wage gains. And it just doesn't happen. But the wage gains become a permanent part of the manufacturing costs, which makes cars even more expensive. And you know how expensive a car is today if you've been shopping for a new car anytime recently. And although you do hear stories like it's getting better, for the models that people want, no, it is not getting better. Cars are not getting cheaper. But you could find models that have already been planned that are just not hot sellers, and consumers could go after those for price. So that's what's going on with that. We'll see how it works. My sense is if labor throws us into a recession, I don't think labor gets the good graces of the country. I think they get blamed for throwing us into a recession, and it'll just make more robotics, and companies will just spend faster on new technology so that they don't have to have labor one day. And that is an ongoing transition, and it'll just accelerate now with the advent of artificial intelligence and super advanced robotics. It's probably going to accelerate that trend. Yeah, so I don't think striking is a good idea. I don't think it works, and it's a short-term buzz that will have a long-term knock-on effect on the industry, on labor, on the overall economy. And for those who are going to be retiring in the next 10 or 15 years, it might be okay. But after that, no, I don't think the labor strike is the friend of automobile people. I don't think the auto strike is a friend of labor. That's my opinion, and I'm sticking to it. Let's just take a quick look. Wait, hold on. Let's take a quick look at how things ended up. This is about as flat of a day as you can get. The Dow's up a mere 6 points, which is nothing on an index that's over 34,000. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. NASDAQ was up 0.01%, up less than 2 points. S&P was up barely over 3 points. These are really just like nothing numbers. It's just a very flat, boring day. Gold up a drop. Oil again is the big story. $92 for West Texas Intermediate. Brent should be hitting 100 soon, I think. And the VIX is still at 14. I'm sensing complacency in the market, but that is, we'll have to wait and see if that comes true. Short-term yields, including the 2-year, continue to remain above 5%, so putting pressure on the overall market. and the 10-year is 4.3. Look, I remember a few months ago that was hitting four, below four, four, below four, solidly in the fours. Where should the 10-year be based on short-term interest rates? The 10-year should probably be rounding 6% right now because the 1-year is 5.4%, as you can see over here. 2-year is 5%. So I think that we have a lot to see with what's going on with interest rates. And it's really hard to make heads or tails of the market. What do investors do in an environment like this? They migrate toward what they think are companies that will grow no matter what, generate cash flow no matter what, and be able to buy back stock no matter what. It comes down to the same couple of companies, the big top 10 market cap stocks that we always talk about in the major averages. Those companies are viewed as companies that could do no wrong, and that's why they continue to attract money. The stocks go up, and they have the effect of holding up the rest of the market just because of their size. Without a reversal from these mega cap companies, you're not going to get a big correction in the S&P 500 or the other averages. That's just the way it is. That's the nature of the market. That's how trading works today. It could change, and not much more to say. All right. So what else could we talk about today? Well, we've been on 11 minutes, and we could talk about consolidating IRAs and asset allocation and things like that. But I think we're on long enough. I just wanted to give you a quick update what's happening with the market. Remember, if you have any questions or concerns, you can always reach out to me. ClientFirstStrategy.com is our website. I'd love to hear from you, and I'll talk to you soon. I'll talk to you tomorrow. Okay. Thanks.